Facing a packed room of business leaders and journalists, the Reserve Bank Governor said relief for borrowers could be in sight.
We are closer to the point where it will be appropriate to pause interest rate increases to allow more time to assess the state of the economy.
Philip Lowe said the hikes are working. The economy is slowing and inflation looks to have peaked. But the next decision will depend on March's economic data.
So we've got a completely open mind about what happens at the next board meeting.
It's been the steepest rise in rates the RBA has ever inflicted, with the cash rate now at 3.6%. In the suburbs of Brisbane, Christine McCarroll's calculations are getting harder.
These rate hikes are going to have a very detrimental effect to the economy. It's hurting a lot of people, and more rate hikes is only going to make it worse.
After 10 rate rises, she has this message for the RBA Governor.
I would like to ask Philip Lowe if he wants to be known as the chief architect of the recession we do not have to have.
Because increases to the cash rate sometimes take up to a year to hit people with mortgages and flow into the economy, not lifting rates at the next RBA board meeting would give the central bank time to assess if its inflation-fighting tactic is working.
You add to that the fact that this year you have 800,000 home buyers coming off fixed interest rates, and that lag is likely to be greater. So I think the Reserve Bank does really need to be careful to wait and see what the full impact is.
Today we examine the Fed's actions.
But the world's biggest economy, the US, is going full steam ahead, set to keep lifting rates until it can get consumer prices to a lower level.
The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy.
And the real effects of that...
Bumpy is an understatement, walking the tightrope of potentially bringing on a recession and throwing millions out of work.
When you're slowing the economy, you're trying to put people out of work. That's your job, is it not?
Not really. We're trying to restore price stability.
Lifting rates in the US weakens our dollar and makes imports more expensive. Inflation is already above 7% and causing a cost of living crunch.
We see more and more people coming to our emergency relief and emergency services, emergency housing services, and it's not just people who are on government benefits. It's now people with, working families, sometimes even with a dual income.
It weighs heavily on my heart and the hearts of the board members, but at the same time we know that if we don't get on top of inflation, higher interest rates, more unemployment, more pain.
The Reserve Bank is using the strongest lever it has, interest rate rises, to try and fight what it sees as a bigger evil, persistently high inflation. But in an era of low wage growth and stretched family budgets, the debate will be whether the pain of the cure is worse than the disease.
Even if it's not officially a recession, it is going to feel very much like one.
No pause on a tough year ahead.